Hey traders, let's go through the course objectives so you know what you'll be learning in this particular course. Now, first of all, the major thing you'll be learning in this course is how to trade off pivot levels. Now, if you're a scalp trader and you want to up your scalp trading game, you should learn how to trade off pivot levels because they're essentially important. They're very important if you're actually trading the markets. If you want to get in and get out of the market on a day-to-day basis very quickly. Also, you'll be learning how to identify valid supply and demand zones. You know, we have zones like the drop-based drop, the rally-based rally, all of that zones, advanced supply and demand zones. You'll be learning how to identify zones like that. Then you'll learn how to trade using liquidity. Now, we have liquidity exists in two forms. We have liquidity pumps and liquidity traps. We leave all of that for the course. If you want to learn how to use liquidity pumps to your advantage and also avoid liquidity traps, then get the course and also stay all the way through. Now, another thing you're going to be learning is how to refine zones to order blocks. Now, you might have been hearing about order blocks and probably you are confused by the concept of order blocks, but don't worry, I'm going to be letting you guys know, breaking everything down to the barest minimum so you can understand how order blocks works. And also, you're going to be seeing me live trade. I'm using the same concepts I teach on here to actually live trade and make money in the market, and how I navigate the market as a scalp trader. So I'll be seeing you guys in the course. Make sure to get the course. If you already got the course, make sure to stay all the way through, and also don't forget to give a review. I'll see you guys. Cheers. Hey guys, before we proceed, let's go over a few disclaimers to actually look out for. First of all, every single course material you're going to be seeing in this course is owned and exclusively managed by the Pirate Academy. It shouldn't be reproduced outside. Secondly, don't send money or make any financial decisions with anyone posing to be a member or staff of this academy. Don't send money to anyone promising you an ebook or a clean strategy or something like that, as we will not be responsible for loss of funds. Secondly, don't give out your personal details, your trading accounts or bank and crypto wallet access to anyone promising you double or instant profits, as we will also not be responsible for loss of funds on that part. Now, we don't offer investment or trading services, just educational services. So anyone actually sending you a message or telling you they're a member or a staff of the Pirate Academy and they're actually going to help you double your profits or flip your trading account, please ignore and report such person, as proper action is going to be taken. With this, let's proceed into the course. Thank you guys. Bye bye. In this lecture, we're going to be talking about how you can spot accurate demand zones to actually buy off from. Now, most of you guys actually jump into the market and tend to mark out random zones and expect price to hold from those zones, but it usually doesn't happen like that. But in this lecture, I'll be showing you guys the criteria you must follow. Is not you can't be an exception. You must follow these criteria to actually get the accurate and precise demand zones that you are looking for. Now, first of all, let's check that we have two types of demand zone. The first type of demand zone we have is the rally, the base, and the rally. Now, this is a continuation demand zone whereby we have the base is the demand zone. The base is the demand zone. Now, what is the purpose of this rally base rally demand zone? This shows that the market was moving. This is basically a continuation type of demand zone. The market was moving in one direction. There was a brief consolidation decision to be made among the buyers and sellers. Then the market continued in the same direction it was going before. So the overall idea for this is for the market to come down, which to come down at this particular point where it's actually moved up from before, because the buyers want to actually buy at a more discounted price. Like the previous, not all buyers jumped in when the market actually made its move up, so they want to actually jump in at a more discounted price, so they bring price all the way down, and then this is where you too buy at a very discounted price and then ride it all the way up. Now, it's basically a continuation demand pattern for you to actually spot and take a trade from. Now, the second type of demand zone that we have is the reversal type. Now, like you see, the market was continuing the same previous movement it was before, but now we're going to be looking at the drop, the base, and the rally. Now, this is a reversal zone whereby the market was moving in one intended direction, and then the market was coming all the way down, and it got to a point where the sellers' powers got exhausted, and then they couldn't sell anymore. And there was a brief consolidation, which becomes the base, which becomes your demand zone, and the buyers actually takes over. Now, what is the purpose of this demand zone is to say that
when the buyers actually took over from the sellers, the banks will want to bring price to the same discounted level where the first move happened, so they can actually buy more contracts at a very, very discounted price. And this is where you should get into to ride the market all the way up. So these are the basic criteria you should look out for before marking out your demand or supply zones. Let me write this out. This is the rally, base, rally, rally, base, rally. For continuation, this is continuation. Yeah. And then we have the drop, base, rally, and this is for reversal. Now you can see these are the two criteria you must follow. It is very compulsory for you to actually follow them before actually trying to spot your demand or supply zone. So now let's jump into the chart. Let's actually look for examples and how this actually works to confirm what we've just learned here. Now looking for demand zones over here, let me pick a pair. Let's see, let's go the AUD USD, much more clearer. Okay, let me take out all we have here. And now, all right, so this is a perfect example right here. Now you can see where the market was going. The market was moving all the way up. You can see we had bullish momentum. The market was moving all the way up, and then the market let's start with this example over here. Now you can see the market was here. It was moving up. We're in a rally. The market was rallying. The same thing going up. Market was rallying, and then we came over here, and then we had a base, and then we had another rally. Now this base is our demand zone because it tells us a lot of buyers and sellers were actually in consolidation until the market took over from it. And then this is your base, your demand zone, and then you expect price to come all the way down in to test the demand zone again. And this is where you look to actually get in, because the banks will want to buy at a very, very discounted price. As before, they wouldn't want to buy at this point. They'll rather take price all the way down. And you can see when the market came down to test the demand zone, it went all the way up. Now in the next lectures, I'll be showing you guys how to actually trade demand zones. Okay, here's a few examples I've actually marked out over here. Let's actually clear this. Let's clear this up. Now you can see where we had this rally. We had the first rally. We had this rally, the first rally, and then we had this area which was the base rally. Then we had the next rally. Now this tells you that the market was going up. They had a brief consolidation, and then the market kept going up, meaning the buyers wanted to still move. The buyers were still in power. So you want to buy this market, but you don't want to start buying at the high or at the peak, because the whole purpose is to buy low. Now you wait. This is how you identify your demand zones. You mark out the whole base, and then you wait for the market to come back. And you can see when the market comes back, it tests the zone and it pushes up immediately, even to higher heights. You can see it pushes up immediately to higher heights. This is the purpose of spotting your demand zones, right? And actually how to spot your demand zones the correct way. Now we had the reversal right here, which is a drop based rally. You can see the market was coming down. This is a beautiful example. The market was coming down. We had a drop. The sellers were in control, and then the market stopped and started consolidating. No definite movement, and then the sellers actually lost power to keep going up. You can see we have the rejections here, and then the market went all the way up. This tells us that okay, the buyers have taken over. How do we actually spot the demand zone? Where was that consolidation happening? It was happening at this base. All right, let's mark out the whole base. Cool. Now, if you bring the base forward, you can see the market came all the way back to test the base, because, like I said, discounted price is always the best to buy from. Like, it's obviously a fact. If you want to buy a new phone, a new pair of shoes, and all that, you wouldn't want to buy it the first time it comes out. You want to wait for the discounted price. That's why even the banks, the market is all about buying and selling. So the discounted price is always the best price to buy from. Now you can see the market came back to buy at a very much discounted price. This is where you should be buying this market at. And you can see from here, the market just kept going. The market just kept going higher and higher. Now, we have another example right here, which is another example of a drop or reversal. Actually, we have another reversal right here. So you can see the market was dropping, the market dropped, and then we had a consolidation. And then you see the sellers' power actually got exhausted. The sellers could not keep it up any longer, and the buyers actually took over, and we had a rally. For us to actually start looking at this as a demand zone, we mark out the base. And don't worry, I'm going to be showing you guys how to trade off and gain confirmations, not just jumping every single base you mark out, how to actually trade it with confirmation. Now you can see over here, the market came back to test the base, and then it went all the way up. So guys, this is how you actually mark out, and these are the criteria you follow to actually mark out your your demand zones, because you can't actually, these are not rules that you can ignore. These are not rules you can do without. They are the basic fundamental rules of spotting your demand zones. In the next lecture, we're going to be talking about spotting your supply zones. Until then, I'll be seeing you then in the next lecture. Hey guys, like I said in the last lecture, we looked at demand zones, and in this lecture, we're going to be looking at supply zones and how you can actually spot supply zones to sell from. Now, like I always say, there are rules you have to follow which you can't actually ignore. Then you can't be an exception to the rules. So first of all, I'm going to be showing you guys the basic two types of supply zones, and probably you might have guessed it from the previous lecture. But the first supply zone is the drop base drop. Now you can see this is a direct opposite of the previous demand zones, the rally based rally, which is just practically, now this is a drop based drop, which simply is a continuation. You can see this is a continuation in the supply zone. Now the market can be moving in one direction, which is obviously down since you're looking to sell. The market is moving to the downside, and then we have a brief consolidation between the buyers and the sellers, and then the market keeps going down. Now the whole idea for it is that the buyers want to actually sell this, the banks want to actually sell this at the most premium price possible. So they bring price all the way back to the supply zone. So then this is where you too look to actually sell from. Now this is a drop based drop kind of zone, where the banks looks to bring price to the lowest point possible for them to actually sell from. There's a drop based drop where the market comes down, consolidates, and then drops, comes back into the supply zone, and then you look to sell from there. Now the second type we have is the rally based drop, which you might have guessed is the reversal. The rally base, now it's not going to have a rally, it's going to drop. Now this is when the buyers actually lose power and then the sellers actually take over. The buyers lose power to keep going up, and then the sellers take over, and then the market is expected to come back into the supply zone and then sell off. Now without saying much, sorry, let me get that. And this is the drop, sorry, this is the rally base drop. You can write this down and note the differences. I'm going to be leaving a resource file too, so you guys can actually have a pictorial guide on how to identify it and get yourselves familiar with it. Now let's not waste too much time. Let's hop into the charts. Now first of all, I have this, and look for a supply zone. Okay, this is the current market. Let's go. All right, let me get rid of this. So the demand zone. Now first of all, you can see over here we had the rally. Now you can see we had a rally, and then we had the base. You can see we had the consolidation, and then instead of market keep going up after this whole base, instead of the market making another rally, we saw a drop. Tells us this is the reversal. The buyers are not in control anymore. They don't have the power to keep going up. So apparently our base is our supply zone, and then mark out the whole base. Now the supply zone is an area. You can see this whole area is the supply zone. This is where we had a lot of sellers in the market. And you can see when the market came in, it sold for a while, and you would have made nice profits with the sell actually before actually trying to reverse. Now if we look at other examples of supply zones, let me look at what I'm trying to make out the best possible supply zones experience. All right, so we had something like this also. You can see we had the rally. See where we had the rally, and then when we had this base, the market came all the way up in the rally. This is not even what I'm looking at. What I'm looking at is right here. We had this rally, the next rally that happened, and then you can see we had this base, and the market didn't give another rally. What did it do instead? It came all the way down and dropped. This tells me the market is looking to actually sell, and this is practically the 1 minute time frame, so you shouldn't be looking for more pips. Like you shouldn't be looking for long moves actually. And now you can see the market came all the way down and then sold massively. Now this is where you should have actually taken this trade, and then you make about, it's about 10 pips, which is apparently beautiful. It's a beautiful trade. And then you can see when the market actually still came in, tested it. Sometimes the zone can get tested multiple times, but the important thing is you're following the rule of identifying the zone. You can see the market came back again and then still sold off, because this is how it actually works. Now if you look closely, you can see when the market actually came in, dropped all the way down. You can see where we had the market dropped, and then we had the base, which was a clean supply zone, and then we have a massive drop to the downside, which tells us, okay, this is a base and the market drops is a continuation for sells. And then if you mark out the zone, the drop, the whole base, you can see when the market came in, it sold off, which is apparently beautiful. You can see the way it sold off. This is the drop base drop, this is the rally base drop. I'm trying to let me pick out another example. Now practically we have, most times we have a drop base drop because there are a lot of continuations. We have a lot of continuations move happening in the market. Let's see how we can, let's pick another example from right here. Okay, trying to find a nice example. Let's go to the present. Let's go to the present. Let's pick a sell side example right here. All right. Okay, now we have a perfect example right here. I don't think I've done this. And now you can see where we had the market rallying. This was a massive rally. Let me go back. Initially, you can see where we had the rally. You see where we had the rally, we had a base, and then we had this rally. The market was going up, and then we had another base. You can see the market was consolidating, and we should expect another rally, but the market actually came down. Now this was a rally based drop, telling us the buyers actually don't want to come all the way up. They don't want to go up. They don't want to keep rallying. They want to drop. So this tells us this is a supply zone because the rally was there. We had a base, and instead of expecting another rally, so this is the basic rule of thumb. When you see a base, depending on the structure, depending on the trend of the market, if it's a rally happening before the base, you should expect a rally or a drop. You don't just predict, just expect a rally or a drop, then you react off what the market is telling you at that point. Now you can see over here we have the base, and then when the market came all the way back, it sold off massively. You can see where it sold off massively. Let me take this away, and then we had more zones. You can see we had a drop, the base, and then when the market came in, it sold off. You can see market came in and then it sold all the way down. Now this is how you spot your supply zones. This is apparently how you spot your supply zones. And let me give you one more example. You can see we had this rally, we had the base. This would have been a very messy, I think this was due to news impact. It would have been a very messy type market for you to trade. But you still face the purpose where we have the rally, the base, and the drop, and you see the market came in, sold off. Now this is how you actually spot your supply and demand zones. In the next lecture, we'll be looking at how to trade off these supply and demand zones, and you don't need to actually mark out the whole zone, and how to refine this to what we call institutional order blocks. So if you got value from this, I would like you guys to check out the resource file I'm going to be dropping below after this course. Just click on it. It's a free cheat sheet for you to actually study these zones and get familiar with them. So with that being said, I'll be seeing you guys in the next lecture.
Welcome back to this lecture, and first things first, I changed my chart colors. I hope you like it. And secondly, in this lecture we're going to be talking about something slightly different, and I'm talking about order blocks. Now in the previous lectures I showed you guys how to identify supply and demand zones, how you can actually know a supply zone and a demand zone, and we'll just do a quick recap. Let me show you guys some examples on this chart right here. And now, like, this is something that I showed you guys. You can see we have over here, we have a rally, we have a base, which is a consolidation, and then we have a rally. Now, like I said, this is a demand zone, and the way you can actually trade this is by actually drawing your demand zone, and then when price comes back into the demand zone, you buy, so it goes all the way up. Now this is very simple, it's step by step and very easy to implement, but this is where the problem is. Now let's say you want to buy this market at this point. You can see, let's say the market comes in here and you want to buy, you put your stop loss here and all of that. Now you put a take profit all the way up here. Now the thing is, you're gonna make money all right, but you can see this is a 67 pip stop loss. Like, who wants to have a 67 pip stop loss? Nobody. And this is why we have order blocks. Now order blocks are basically just supply and demand zones, but they are refined supply and demand zones, and this is what I'm going to be showing you guys. Now let me take all of this. I'm still using this example. Now instead of marking out this, imagine I want to buy off this. I saw the rally, the base and the rally, and I wanted to buy off this demand area. I want to capitalize on this. Now instead of me actually drawing the whole demand zone, what am I going to be doing? I'm going to be refining this into an order block. I'll refine this into an order block, and then what happens? I refine into an order block, and then I take my trade when the market comes in. Now let's look at what happens when we find this into an order block and when the market comes in. Now you can see my stop loss goes down to 30 pips, and now my risk to reward becomes much more better. This is a 1 to 3, that's why it is a 1 to 4 risk to reward ratio as opposed to a 1 to 1 previously. Now you might be asking me, how do I know an order block? Now this is very simple. The way we have two simple rules if you want to refine your zones to order block. Now the first simple rule for you to actually refine your zones to order block is following this rule. Now when you see a rally, now this applies either a supply or demand zone, but we're going to be doing that. I'm going to be showing you guys two examples both from demand and supply aspect. Now when you see, let's say for example, we have a demand zone here, we have the rally, the base and the rally. Now this is what you should be looking at. Now what you're expecting is a rally. You're expecting a rally, so you're expecting if the market comes down to this demand zone, you should be getting another rally. This is what you are expecting. So what you should be looking at is the last candle that caused the rally. And you can see over here when the market was creating the zone, we have the last candle where the market stopped down. You can see the market was been consolidating over here, and then if you look closely, you can see after this big bearish candle, we had this candle right here before the market started moving up. So this was the candle that ended the sells and began the buys. So that is a point of interest. Now that is our order block. That is where you refine this and call it an order block, and it's much more easier to actually trade off of because now you're actually identifying a point. Now during this whole supply zone, during this whole demand zone, just tells you that okay, now during this whole demand zone, what it actually says is that I'm expecting price to come in and react somewhere, and by somewhere you don't actually know where, because sometimes you might buy here. Let's say imagine you bought here, imagine you bought at this point, imagine you bought, let me make this, imagine you bought at this point, but the market still kept coming down. You see, you would have been devastated and like, what is happening? But since you already knew where the market was going to go to, if you actually refine to your order block, you'll be expecting the market to only react and move up when it comes to your order block. Now let's go for another example. Let me show you guys what I was actually talking about. Now if you see over here, we also have another example, clear example over here. Let's have this. Now you can see over here, sorry about that, you can see over here we have a rally, and then we have base, and then we have another rally. Now this is another demand zone, and so looking at this demand zone, like you originally know, mark out the whole, at least this is what I taught you guys in the previous lectures. You mark out the whole zone, and then when the market comes back, you can actually buy. Now when the market comes back to this zone, what happens? You buy from here, and now your stop loss is way below here for 83 pips and 83 pips for 64. You can see the risk to reward is not even up to a 1 to 1. That is another disadvantage of it. It actually does not increase your risk to reward, and you don't even know when price is going to react off it and move up. But like I said, this is the whole base. What you have to do is to analyze the whole base. Now analyzing the whole base, like I said, now the two rules are, the first rule is if it's in a demand scenario like this, the last candle that stopped the sells and began the buys is what is your order block. If you're in a sell supply scenario, it's the last candle that stopped the buys and began the sells. So we're going to be going through all of that. Now you can see over here we have this whole base. Then you can see we have this candle right here. This candle was the candle that stopped the sells and actually began the buys. It stopped the sell right here and then began the buys all the way up. After that, this is what caused the rally. So what you're going to be doing is to refine all the zone. You refine your zone down to this order block, and then you can see the market came in perfectly. And now let me show you what this does to the risk to reward ratio. See what this does to your risk to reward ratio. Increases your risk to reward ratio. Now you have a 1 to 2, you can call it, okay, a 1.1 to 1.9. Increases your risk to reward ratio is like a 1 to 2, a very beautiful risk to reward ratio, and you can actually know where the market is actually reacting off of, not just actually trying to guess. Now let's move into a supply scenario. I can see a very good supply zone over here. Now you can see over here we have like a base, the drop, the base and the drop. Now this tells us this is a valid area of supply, and then like as usual you mark out the whole zone. Now this is, like I said, I don't need to over highlight the whole disadvantages anymore, but let me show you guys something. Now you have a 58 pip stop loss, and so sorry guys, and our 1 to 7 risk to reward ratio over here. Now this is really not all that fair. Now let me show you guys something. Now over here, what you should actually be doing is analyzing the base and seeing where your order block can come from, or where your order block can come from. You can see when the market did a drop, you had a rally, and then we had this up here. You can see where the buys stop. You can see this candle that stopped the buys and began the sells. This black candle over here, it stopped the buys and began the sells. So that should tell you this is your order block. That is your order block. And see what happens when the market comes into your order block. Very beautiful, very perfect. Your stop loss reduces, your risk to reward increases, and the same area that gave you 1 to 1.9 begins to give you 1 to 4 risk to reward ratio. And that's how this actually works. This is how the zone actually works. How you actually use order blocks to refine your zones to order blocks. Now I just give you guys one more final example. I'm trying to get something as live as possible. I'm trying to give you guys one more final example. Okay, we have one more right here. Now you can see this is a reversal kind of zone. We have the drop, and then we have the base, and then we have the rally. Now this tells you this is a very clean zone. Now this tells you we have to mark out the whole base. Like I said, the second rule is if you're in a demand scenario, you should look for the candle that stopped the sells and began the buys. Now you can see the candle that stopped the sells and began the buys was this green candle over here. So which is why I'm going to be refining that all the way. We're refining that, and then you can see how, now this is a very perfect entry. You can see how the market came in perfectly, tapped in, and didn't even waste time before actually going all the way up. And this is how beautiful, and this is the beauty of actually refining your supply and demand zones into order blocks. Well, I hope you guys actually took value from this particular lecture. In the next lectures, I'll be showing you guys how to actually trade order blocks and how to mark up your chart so you can trade order blocks. So I'll be seeing you guys in the next lecture. Take care, everybody. Bye-bye. Hello guys, and welcome back to the lecture. In this lecture, we'll be talking about pivot levels. Now you might have been hearing about pivot levels. You might have heard some people, some traders say they trade with psychological levels. You might have heard some say stuff like areas of interest, point of interest, and it sounded strange to you. Well, in this particular lecture, I'll be breaking down. I won't even actually go into full details. I'll be making everything simplified for you to actually know why they actually call that pivot levels or stuff like that. So I call it pivot levels, and if you're a scalp trader and you want to actually advance your scalping game, pivot levels are very important for you to implement your trading. Now, pivot levels to me are confirmations for the zones I want to actually trade with. Now, you might ask me how. Now, the thing is, most times you might have a zone. Let's say this, you might have a zone. And now, I'm talking to sorry, let me clear this, let me do it again. Now, I'm talking to some of the experienced scalp traders here. You might see a zone, a very good zone. And some of you guys might actually encounter this. And then when the market comes in, you just buy without confirmation, and then the market moves a little bit in your way and then takes you out. Or sometimes it doesn't even move in your way, it takes you out immediately, and then you start asking yourself why, because to you the zone was good, and truly the zone was good, but you needed confirmation. So for you guys to actually understand, you need to take a trade with confirmation. And if you don't know how to look for confirmation, this is why you need pivot levels. This is just why you need your pivot levels. And now let's start. Let me give you guys a very quick run up, an example of your pivot levels. Now over here you can see we had a whole base rally. We had a base. Yeah, you can see we had a rally, the base. Oh, this was a drop base rally actually. Then you can see we had the order block. We mark up the order block like this, and then the market came into the order block. Now like this, market came in here. Now, one thing I want to say, if you're a scalp trader, this is actually done on the 1 hour. You should actually start from the 1 hour, because you're looking to get into them, getting out of the market within a couple of hours, within a particular trading session. You're looking to get in and get out of the market within a particular trading session. So you should be starting from the hourly time frame. And then from the hourly time frame, you've marked out your zone. You should be going down to the 5 minutes to look for confirmation. Now, let's imagine we wanted to buy from this, but we don't know the market is going to buy yet. So how do we know the market is going to buy? Pivot levels. Now, where is our pivot levels? My first pivot level is here, and my second pivot level is here. Now you might say, how are these pivot levels? Or I like to use zones. Let me use zones with that. My first pivot levels, let me make this ash, and then my second pivot level is here. Now you might say these are support and resistance zones. Yes, these are, to put it simply as that, these are support and resistance zones. And the reason for this is that trading supply and demand is very different. It's very similar, if not the same thing, with trading support and resistance. Now supply and demand zones and support and resistance zones are very similar. Support zones are areas of buyers and areas where there are a lot of traders willing to buy. The same thing with the demand zone, and the resistance zone is the same with the supply zone, which is an area where traders are willing to sell. So if you're going to be actually getting support zones in a demand area, that's a confluence, that's a confirmation that the buyers are actually taking over. Now you can see, first of all, we had this first support zone. I usually enter off the first support zone. We have this first support zone within the demand zone, which is, you can call it support zone, you can call it a pivot level, but we had this first support zone within the demand zone, and then what happens, the market comes in, breaks out, retests on it, and then it buys all the way up. And then we have the second zone. The market does what? You can see how strong this is. Now you can choose to disregard this, but you cannot deny how strong the market is. You see, rejected off it, consolidated off it. It could not break it. It could not break it at all until it finally did break it. And when it broke it, you can see the momentum it moved up with so much massive momentum. If you had bought this, you would have capitalized heavily on this. You would have capitalized heavily on this particular trade. Now let's get another example. Go down to the 1 hour. Let me clear all of this. Let's clear all of this, and then let's see. Now you can see we have this area here. Okay, I don't think this is not a very, let's pick a random pair. Let's go AUD CAD. All right, so we have this zone right here. Now notice the 1 hour, we have this base, the rally base, and the rally refining to this order block over here. Let me move this order block, and then going down to the 5 minutes to actually pick out our pivot level. So over here, this is our pivot level. Let me pick this up. Okay, now you can see here we have this zone. We have this zone right here. Let me draw this. We have this zone. Now this is how you're going to actually be knowing your zone. You can just pick the last low. You can see areas like this, the last low before the market actually started shifting direction. You can see we have zones like this, we have zones like this, and the market came in, found it. You see the market reacted off this level before coming into the zone, then found it hard to break the zone. When it broke the zone, it finally retested on the zone, and before it finally moved up, it actually took time. It could have moved up easily from here, but I think it had to come all the way back. Didn't come back to the zone. But the most important thing is, once the zone is being broken in the direction of the demand area, or now if you're in supply area, we're going to be doing next another lecture on the supply zones. If you're in demand area, if the support is being broken in your direction, you should actually see that as a confirmation. If you're in supply area, if the resistance is being broken in your direction, you should see that as a confluence, as a confirmation. Now, like I said, you can see the first zone here was being broken in my direction. All I'm taking is buys from here, move all the way up, and then the second instance was actually broken again in my direction and closed above it. This is another opportunity to enter this trade. Well guys, I hope you guys got value from this particular lecture. In the next lecture, we're going to be looking at how to actually look at pivot levels for supply zones, how to mark them out on the charts, and also how to trade them, how to enter and exit off of them. I'll be seeing you guys in the next lecture. Take care everybody, bye bye. Hey guys, welcome to the second part of trading with pivot levels. Now, in the first lecture, the part 1 of this, I actually showed you guys how to actually identify pivot levels. What are pivot levels? And I actually showed you an example of using pivot levels in a demand setting. Now, in this particular lecture, I'll be showing you guys how to use pivot levels typically in a demand and supply setting, and how you can actually approach the charts using pivot levels, also with your order blocks, and using pivot levels as a scalp trader. This is actually one of the best ways to confirm your zones
as a scalp trader. Now, like I said, you go to the 1 hour. This is the time frame the scalp traders usually start from, and the 1 hour is actually one of the best time frames for me because it actually helps me get in and get out of the market. I cannot start from the 4 hourly. The 4 hourly is for day traders. The daily is usually for day traders and sometimes swing traders. But the hourly is the best because you're trading within sessions, and one trading session contains 4 hours. So you're just like you're trading within hours. So the hourly is the best. So now over here you can see we have this nice zone. You see we had a rally, then we had a base, and we had a drop. Now this was a supply zone, a very nice supply zone. We have the base over here, and then let me pick up this order block. You can see this order block where the buy stopped and the sells started. Like I said, the market came through and all of that, but let's put that aside. Now when the market came in here, like I said, you have to look for your pivot levels that are actually going to correlate and tell you the market is going to sell. Now the market is in a supply zone, fine. The market is in a supply zone. We are looking to sell from the supply zone, but how are we sure this supply zone is going to hold? If we get a pivot level that actually confluences with this supply zone, so meaning if we can get a resistance zone that can actually confluence with this zone, then we're going to be actually looking to sell. So go down to the 5 minutes, which is very systematic and easy to implement trading. And then you can see, let me pick this up. You can see we have a very strong pivot level right here. Let me pick this. This is the first. I think we have the first right here. Okay, we have a couple of zones inside. Now you should actually understand two things. First of all, you should be looking at areas of consolidation, areas of interest, areas that price reacted more than once. And if we look at this area, you can see price, let me make this blue, within the zone. So if you can find areas like this within the zone, you can see over here, let me play this. You can see when the market came here, it actually rejected. It came here, rejected. It had trouble over here, and then when it broke with this fat ass candle, this is where I'm going to be entering. Don't worry, in the next lecture we're going to be talking about how you can enter off pivot levels and how you can actually enter them very softly. So you can see right here, market came here, rejections. Now like I said, you just need to look for areas of interest, areas of troubles, areas where you see price has reacted more than once within your zone. The best way to do it is actually to look for those areas within your zone, because if you're actually looking for sells within the supply zone, you should actually know that the market should give you a resistance zone, should give you a pivot level, should give you some confluence that it's willing to sell at that zone. And now you can see when the market broke below, it came back to make a retest and it sold off. Unfortunately, the sell didn't last all that long. But if you're a scalper, you shouldn't mind, because if you're taking this trade, this is more like a 1 to 2, which is more than enough if you're really a scalp trader. Let me take away this pivot level. You can see even when it broke this pivot level, it came back to make a retest and then it just went down. This trade would have held, but for some reasons, I don't know how to predict the market. I only react off what the market does. And as you can see, the market would have done this, you would have gotten your 1 to 2 risk to reward ratio. Now let's get another example so you can actually understand this better. Let me go to GBP MC or GBP AUD. Let's get a nice, so go down to the 1 hour. Let me show you guys how you can actually spot your pivot levels and what kind of pivot levels you're gonna be using. Okay, let's use something like this. I think this is a very nice, it hasn't happened yet. I think it's very nice. It hasn't happened yet. So we can see over here the market is very take this out. You can see we have this base, very nice base. Now this has not happened yet, so this should give you even a more in-depth insight. This is a real world insight, real life market. The market is currently closed right now, so you can see this is a rally. We come down, we have the base, you can see the base, and then we had another rally, and then the market is going all the way up. We have this order block right here. You can see we have this order block right here, and the market has come into the order block the first time, come to the order block the second time. And let's say today is, as of the time I'm recording this video, today is Sunday. The market is going to open in a few hours, so I'm going to be seeing what's going to happen. But let's see here, let me break it down for you guys so you guys can know how to actually apply it in your own trading. So overall, we've identified our demand zone right here. the market came into our demand zone, and we had something that I like to call exhaustion. Now this is something I'm going to be teaching you guys also in the next lectures. This is something I like to call exhaustion. You don't need it now, but I'll be showing you guys in the next lectures to come. So this tells me that the seller's power is actually going off, and then the buyers are actually willing to take over. So I'm going to go down into the 5 minutes to actually look for my pivot level. Now my whole idea of looking for my pivot level is that if this market really wants to buy, then it should give me a demand zone or a support zone within my demand zone. Because if it's willing to buy, it should give me a support zone within my demand zone. So how do I get a support zone? First of all, I have to look at areas where the market has reacted more than once within my zone. Now if we're looking, we can see areas like this. Very good. Now this is a very nice area to actually look out for. Now you can see over here the market reacted off this level. Coming to the market reacted off this level, came here, reacted. You see the market reacted off this level, and then when it came here, it broke this. Now I would have naturally entered off this break. Naturally I would have entered off this break right here, this candle, but I think this was after the market was trying to close and all of that. You can see the consolidation, the chopping movements and all that. So the market did not have much volume to just keep going. It tried, you can see the market tried, but we have this choppy. And also we can have the second level right here, which is, you can see where the market reacted. The market reacted, came here, reacted, went down, reacted here. Now this levels, what I'm looking for is, since the market is in a demand zone and it's telling me it's willing to buy, what I'm waiting for is for it to do something like this. Once it breaks, now if the market is going to open and break above and either retest or at the break, I'm going to enter. If it breaks above this zone, what it's telling me is that yes, the buyers are taking over, because the demand zone is an area of buyers, and if the support zone can be broken in confluence with the demand zone, it tells me yes, the buyers are actually taking over. You need to buy this trade, and that is what I'm going to be doing on GBP AUD. So this is how you actually apply this in a real world scenario. You guys can see a real live market scenario, waiting for the market to open. I might update you guys on this trade later, and we'll see how it actually plays out. Now guys, I hope you guys actually learned how to spot your pivot levels, and in the next lecture we're going to be doing something different. We're going to actually be looking at something called volumes, how you can actually use volumes to trade off your pivot levels. And I hope you guys got value from this. I'll be seeing you guys in the next one. Take care everybody. Bye bye. Trading Pirate here again, and in this lecture we'll be talking about the entry models you need, or the entry types, or the types of entries, the two main type of entries you need to actually enter off your confirmation pivot levels. Now it's very crucial to know when to enter a trade, because entry is everything. You can have a good trade, a good setup, but if you don't know how to execute an entry, then you don't know how to trade. Now I'm going to be giving you guys the only two main entry types, and they are so simple to the point where you don't even need to rack your brain or even try to think of how you're going to remember all of this. Now the first of all, those two entry types are actually based off of volume. When I say volume, I mean volume, the strength of the move, and the willingness, the amount of buyers and sellers. It depends, either the amount of buyers or the amount of sellers in that particular trade. Now how do you actually identify volume? Now don't worry, you don't need any indicator, you don't need anything. All you need is just simple price action, and I'll show you guys how to do it with simple price action. So over here we have AUD card, and we are on the 1 hour time frame. We're on the 1 hour time frame over here, and then you can see we have this nice demand zone. We have the zone, then we have this order block right there. This nice order block. Let's move this here. We have this nice order block, and yeah, and like I told you, you've gotten your order block. First, the next thing you need to do is to go down to the 5 minutes to actually go check your demand zone, to check for your pivot levels. Now I'm going to extend this a little bit so you can check for your pivot levels. Now like I said, you need to check for your pivot levels within the zone, and in this particular case we need to check for your support zone within this particular demand zone. So first of all, what we're going to be looking at is this level. This is a very good zone. let me put a line there so I can actually mark it. You can see we have a very strong zone right here where market reacted very well. Let me put a line there so I can be able to draw it. Okay, coming over here, I like to draw it like this, draw it over here. Yeah, we have this line. Now let me make this blue, and then we also have the next zone over here. You can see it's a very strong zone right here. Now I'll be showing you guys what I mean by volume. Now the two types of volume entries you actually need is depending on the size of the candle that breaks the zone. Now let's say you have a zone, this is your confirmation zone, and then you have price action breaking the zone. Now you need to understand, if price action comes through and breaks this zone with a lot of volume, like very massive, a lot of volume, it should actually be entering this trade. You should enter this trade immediately. Like, you need to see a lot of volume, and you will see a lot of volume. Volume is determined by the size of the candle breaking the zone. So when you see this, you should know that there's a lot of volume actually. So you jump in immediately, and then you buy all the way up. Now another way to actually trade this is if you are actually, let's say, the same scenario, but the zone is being broken with lesser volume. Like you can see choppy candles, the candles are not so big, but now once you see something like this happening where the zone is not being broken with a lot of volume, like a massive volume candle like this, don't just enter immediately, because what is happening is that the market is building momentum. Because over here what it's telling you is that there's still a struggle. Now here, when the market breaks through with a very big candle, what it tells you is that the buyers has already established dominance over here. They have established total dominance over here, and said we are looking to buy, so we are breaking this support zone. Now if the market is actually doing this and breaks with this kind of price action, what it's telling you is that the buyers are undecided yet. They are very undecided yet. The buyers and the sellers are undecided yet. But if it breaks through, most times it's not going to break through with this kind of price action. It's just going to get to this point. Most times it's just going to get to this point and then just keeps going down. So you know the zone is not valid. But if it actually breaks through, one thing you should actually expect is for the market to come all the way down. Now it's going to come all the way down to test this zone again. Now what is happening right here is that the buyers and the sellers are actually consolidating. Are we willing to go up or come down? So they're going to bring the market down all the way here, and if this zone is willing to hold, then you're going to be seeing a very good move to the upside for you to take a trade in. Now this applies the same way also if you're looking for a sell side scenario. Let me make this red. Now this applies the same way we're looking for a sell side scenario, whereby if you see your resistance zone from the supply zone got broken with massive volume, this tells you the sellers have already established dominance. Is your time. It's just simply your signal to enter the trade. Oh shit. Let me put this here. All right, it's your signal to enter the trade and ride it all the way. But if you're actually seeing something like this, and the market is doing something like this, just keep breaking. What I'm gonna tell you is that always ensure to wait for something. Always ensure to wait for the market, because the market will always come back. It's gonna always come back to test if they're gonna hold or not. So let's jump into the row chart. Let me be showing you guys how to actually, now over here, like the zones we have drawn our pivot levels over here. You can see our pivot levels over here we've drawn. Now you can see over here we had the first pivot level. This was this pivot level. The market reacted here, and then you can see the kind of candle it broke through with. But I guess this pivot level wasn't that effective, so the market didn't come all the way back down. But let me show you something. Over here, the market, this pivot level was very good. You can see we had a lot of rejections here, and when it was time for the market to break through, the market broke through, but the candles were not massive. When I'm talking about massive breakthrough, I'm talking about breaks like this with candles like this. I'm talking about breaks with candles like this. So we have choppy candles. You can see we have candles everywhere, and the market came back to test the zone. You can see it went up, but it came back to test this area to show if the market is going to go. And for you to actually know that it's going to work out, the market printed this candle to actually go all the way up. Although it actually came back, I believed it came back to test this zone. You can see it came all the way down here to test this zone, but it didn't hold. it didn't hold. Or maybe if I had drawn the zone somehow like this, okay, let's call this the zone, because you can see over here we had the rejections, over here we had the rejections, the rejections all over. You see we broke through with the rejections, rather we broke through with all the rejections. Now you should understand that you should only be looking for your confirmation only when the market is in a supply or demand zone. So you shouldn't just draw a zone and start looking for confirmations when the market hasn't hit your zone yet. So now you can see the market broke through choppy candles. It came all the way back down. And what did it do when it came all the way back down? It spiked, printed a very fat candle. Now, if this kind of candle had broken this zone before, I'm not going to be waiting for it to come down. I'm just going to enter from here. But since the candle broke through this way, I know I'm going to be waiting for it to come back down. And you see, that's exactly what it did. Came back down, and this is where you enter a trade like this. Enter a trade like this, probably stop loss way below here, and your take profit can be anywhere you want. It would have been a nice 1 to 2.7. Remember, you're scalp trading, so you don't need to chase all the moves in the market, but that is how you actually run do it. Now let's try a random pair. Let's say euro and ZD. It's a nice pair. Let's see if we can get something out of it. First of all, go down to the 1R. I'm gonna give you guys this example, make it so easy for you guys to understand how to use it. Now, okay, I think we have very nice zone here where we had the supply zone. You can see we had the supply zone. Yeah, I'll leave this and make this green. We had the supply zone where the market came in and then sold off. Now imagine the market came in the supply zone in the beginning. Now we had a supply zone here. We're going to be looking also into this. We had a supply zone here, but yeah, we're going to be looking into this also to see. This is to show you why you should be waiting for confirmation. Now we had this on the 1 hour, and then let's go to the 5. Let's go to the 5 actually to look for our confirmations. Now to go to the 5, you can see first of all we had no. If we are going on the 5, we're checking out the first zone right now. In the first zone we had 0 to no pivot levels being broken. First of all, you can see, or let's call this, okay, we can call this a pivot level. Areas like this, pivot level, but you can see we had no many reactions. How many areas did the market react of this pivot level? Just one. Just one. It's not a strong pivot level. Even if we're talking about here, it's just one. It's not a strong pivot level. So this zone is even disqualified from the beginning. So let's go on to the main zone. Let's get this off. This is not a valid zone. Let's get this off and see the amount of volume the market actually broke this zone with. Now, coming to the zone, we have pivot level number 1. We have this, exactly. Let me draw a zone there. Let me make this a zone. All right, you can see how we have multiple areas. Let me make this blue. Sorry, let me make this red. It's better red. Now, let me zoom this a little bit so you guys can see. Now you guys can see the pivot levels we have. You can see the pivot levels we have reacted the first time, the second time, the third time. And then when the price went through, it rejected. You can see this was a strong pivot level. It rejected this much. And then when it rejected this much, it came down. Then it broke through with this fat candle. But this candle did not fully break it. So you can see the kind of candle we actually used to break it. 1 short candle, 2 short candle, 3 short candles. 4. Although this was a candle of volume, I would have saved myself all of this stress and jumped in immediately. Why? But I don't advise you do that. You should usually wait for confirmation. But since I know what's going to happen from an expert's opinion, I'm going to jump in right here because of the size of this candle I'm seeing right here. I'm seeing the size of this candle right here. The market is telling me sellers are in control. You can see this resistance zone holding up very nicely, and then you have a fat candle. The sellers are telling us they're actually dominating. So what am I going to be doing? I'm going to actually jump into the zone, but you'll have to wait. You can wait. You can see when the market came down with these choppy candles, very low volume. What did the market do? The market went back, tested the zone, and then pushed down. And then this is where you actually be looking to take this trade. Your stop loss there, and then you look to take this trade right here. You just get your trade and get your money and leave the market. You see, get a trade, get your money and leave the market. In the hard, this is a 1 to 3. You can get a 1 to 5 trading this way. So guys, I think that's the 2 ways you actually trade with volume. You either wait for the massive candle For high volume, you enter immediately. For low volume breaks, you actually wait for the market to come back to react and retest that area to give you confirmation. So I hope you guys got value from this, and also if you also leave a review on the course so far, your questions, your thoughts, your opinions, and what you've noticed so far. Every single review is actually attended to, replied, and actually appreciated. I'll be seeing you guys in the next lecture. Take care, everybody. Bye bye. Hey guys, and welcome back to the lecture. In this particular section, we'll be talking about liquidity and its traps. Now, liquidity in trading is a concept that has been given a different name and different meaning by a lot of different traders. But in this particular lecture, I will do my best to make it as simple as possible for you guys to understand what liquidity is. Now, first of all, you need to disregard every other thing you've been hearing about liquidity and all the nonsense these traders have been telling you about liquidity, telling you liquidity means your stop losses. No, that's nonsense. Liquidity doesn't mean your stop losses, because the banks don't even know where your stop losses are. The market makers don't know where your stop losses are. So it's a lie. Now, what liquidity actually truly means is the amount of money being pumped in the market. Now, imagine when you get up in the morning and you go on to London session. Now, London session, the pairs we have that move most during London session is GBP, JPY, the pound, the dollar, and most times, the pound, the dollar, and the yen. Now, those pairs, especially GBP, JPY, and Euro USD, they move very, very fast during those times. Now, why do you think they move that fast during those times? It's because there's enough liquidity in the market. It is because there is enough liquidity in the market to sustain the movements. A lot of money is being pumped in the market. Now, the same thing happens during the New York Stock Exchange Open when US 30 and the Nasdaq move so fast. It's because there's a lot of liquidity in the market at the point. Now, how do you translate liquidity to actually read it on the charts? Now, this is very simple. Like I said, liquidity is when a lot of money is being pumped in the market, making a particular pair volatile. Now, for you to actually see where a lot of money is being pumped in the market, you need to actually look out for massive movements. Now, when you see massive movements, it actually helps you in your trading to spot the zones that you need. Now, let's jump right into the charts. We will be looking at many things from here. We'll be looking at many things from here that we can actually use to spot liquidity. Now, let's look at it. Over here, we have more of a buy scenario right here. Now, this particular pair is liquid, very liquid at this point, because now when I say liquidity, this is what I mean. You can see from here all the way to here, we have a very big, massive move. Now, this tells me there's liquidity in the market. And now, if you want to actually trade, look for your demand or your supply zones. The best zones to look for are the ones during liquid session, are the ones that happens after a liquidity pump. Now, you can look at this. You can see we have this big liquidity pump right here, this big move. And then what happened? Immediately it created a base right here. You can see we created a base. How beautiful is that? And immediately we created a base. You can refine it to this order block. Now, immediately we created a base, you wait for the market to come out, and like I taught you in the previous lectures, you jump in, and then you can see how the market actually moves up. Now, this is not you can see the same thing happen here. Now, you can see that not every demand zone is going to hold, because the best demand zones or the best zones in general are the ones that happens after a liquidity pump. Now, you can see this was a base, but the market did not come back to it because there was no liquidity pump. In fact, the market was choppy at this point. But if you look over here, coming here, you can see the market did another pump. Now, this tells you there's a lot of money being pumped into the market. The market is being liquid. There's a lot of liquidity in the market right now. And then it gave you a very nice base right here. You can see we had a nice base. And if you want to refine this to this other block right here and draw it here, let's see what happens. Boom, you can see from here when you got it and it went all the way in, it moved all the way up. And like I told you, if the zone doesn't have enough liquidity, if the pump to the upside is not enough, you're not going to find a very good zone to actually trade off of. This is how liquidity works, how you can actually use liquidity to your own advantage. Now, let me show you guys another example right here. You can see we have this is a sell side scenario. You can see we have the liquidity pump to the downside. It's a very nice liquidity pump. We have liquidity pump to the downside, and then when the market happened, the market created a base, and then it went all the way down. Now, like I said, you mark out this base because this is what you're interested in.
This zone this is what we call a high probability zone. Why? Because it shows after a liquidity pump. It shows after a liquidity pump. Tells you that the market is very willing to go all the way down. You can refine this all the way somewhere here, and you can see how good this works. How good. So this is how you can actually use liquidity to your own advantage. This is how you can use liquidity to your own advantage. And yeah, so guys, I hope you guys actually learned something from this. Learn how you can actually use liquidity. What is liquidity, and not the lies you have been fed about liquidity. This is actually the truth of liquidity, and this is how you can use it, because all you need to do to find your high probability zone is just one liquid point, one area of liquidity. That's what you need to find your high probability zone. So guys, if you like this lecture and if you've been enjoying this course in general, don't well to leave a review on this course, and I'll be seeing you guys in the next lecture. We'll be talking about liquidity traps and how you can actually avoid the traps. So I'll be seeing you guys. Take care, everybody. Bye. Hello guys, and welcome back to the lecture. In this lecture, we'll be talking about liquidity traps. Now, in the previous lecture, we talked about liquidity and how you can use it in your trading, and I told you guys the meaning of liquidity and how to use liquidity pumps. Now, because I showed you guys how to use liquidity pump doesn't mean it's going to happen always. What the truth is actually that not all liquidity pumps are actually going to work out well for you, and this is why you need to avoid things like liquidity traps. Now, like initially, like I said, liquidity pumps are actually big moves that happen in the market, and when you see big moves happen in the market is bound to respect areas like that. When you see pumps, you can see right here we have like a pump. Over here we have a pump in the market. You can see where the market pump created a base, and then it moved up. But I'm going to be showing you guys liquidity traps and how you can spot liquidity traps and how you can actually avoid liquidity traps. Now, first of all, the first thing you should be looking out for in liquidity traps is the candle. Now, there are what we call weak lows and weak highs. Weak lows and weak highs are actually structural points where the candle is not closed fully, and I'll be showing you strong highs, and I'll also be showing you weak high. Now you can see this over here is a strong high. Over here we have a strong high. Why? Because this is a full candle. You can see we have a strong high. This is a full candle, and then all of these are weak lows. You can see here this is a weak low. We have also another weak low. And now what happens to weak lows is that they are always rated. Like the market will always come back to sweep them off. Maybe not today, maybe not tomorrow, but eventually the market will always come back to sweep them off. Now you can see areas like this. These are strong lows, strong highs. These are strong lows and strong highs. You can see we have full candle highs and lows right here. Full candle highs and lows, and that's why the market respects demand zones like this, and even supply zones. It depends. Now let me show you something from here. Show you why you shouldn't be using weak lows and weak highs. Now if you look over here, you can see we have these candles. We don't have full candles over here. You can see these highs are not full candles. Over here these highs are not full candles at all. And what happens, you can see we have also these lows are not full candles. And now before you think this is not going to actually be something that will work, let me show you guys. Now look at what happens to all the demand zones the weak highs create. You can see all the demand zones, the market reacts off a little bit and then it fills it. You can see we have another base right here. Let me refine this. You can see the market doesn't even hold at all, because the highs are weak highs. They are not strong highs and strong lows. Now if we look over here, we also have this supply zone over here where we have this base, and what happens, the market does not respect it. The market does not respect it because it's a weak low. We have a weak low here, and then we have weak highs over here. And like I said, if you look over here, you can see that we have strong highs. And the best way to avoid these traps is that because you can get this now and you want to enter off this, the market actually stops you out and takes your money. Now this is liquidity traps where the pumps actually doesn't work as much as it wants to work. You can only identify the pumps that are going to liquidity pumps that work for you when you actually use go for strong highs and strong lows using this method I'm teaching you guys right here. Now like I said, over here you can see we have a lot of weak highs, weak lows. Let me go on to random pair. Let me go Euro card. I think have we gone through this pair before? Okay, let's pick out strong highs and strong lows, and then we pick out weak highs and weak lows. Now first of all, let me look for a liquidity pump. like to make this as good as possible. Let's look for a liquidity pump. All right, so you can see we have something like this. Let's come over here. I think I've done something here before. Okay, let's come over here. Now you can see what we have over here. You can see how strong of a high we have over here. You can see the strong highs we have, strong highs and strong lows. You can see over here we see we have strong highs and then we have strong lows. This is another thing you should consider when you're looking for your demand and supply zones after a liquidity pump. Now you can get other supply and demand zones, but the ones with the liquidity pump are actually the best for you to actually get. And if you draw this, you can see the market actually held on. Okay, the market didn't react to this zone, but if you draw this, you see the market actually reacted up this zone, a very strong zone for that matter, and then it held all the way through. Now if you see all over here, the market also did the same thing. We had strong highs and strong lows. Let me mark out this order block. Of course, now you can see what the market did. It reacted and it came all the way down. It sold for a while. Now let's look over here where we had this zone. Now you can see we have another type of supply zone here, which is a rally, a base, and then a drop type of zone. Now what do we do with the rally base drop type of zone? You can see, but the problem with this zone is that you can see we have a weak high. Not just one weak high, we have another weak high. Now these are liquidity traps. All of these are liquidity traps. And now when the market creates this supply zone and then you want to mark out your order block from this, you can see what happens. The market reacts a little bit and then it spikes through and to take all your money. So this is, remember what I always said, liquidity traps will always get swept out. All weak highs and weak lows will always get swept out. And now you can see over here, this was a weak high and also a weak low. We had a weak high. Now if supply doesn't work, we should expect demand to work, right? Now that should be the case, but you can see over here, if you mark out this order block, as expecting it to hold for a buy, over here, what are you going to be seeing here? Instead of this order block to hold for a buy as a demand zone, it actually fails because we have weak highs and then we have weak lows over here. These highs and the lows are very, very weak. And then the same thing actually happens here. You can see when the market came down and then it fails all the way through. So guys, this is how you spot weak highs and weak lows in the market. The best thing about spotting weak highs and weak lows is that it helps you know the zones you actually have to trade off of. And actually the zones you trade off is very, very crucial, because if you don't trade off the right zones, like I told you, the zones with the liquidity pump, and you avoid liquidity traps. Now these are two things. First of all, you want to enter off zones that are strong with massive liquidity pump, but you still want to avoid the liquidity traps. And you avoid the liquidity traps when you see the area you are trading with, the zone you're about to pick, has a weak high or a weak low, depending on the movement of the market. So guys, I hope you guys got value from this. If you like this course, and also if you like this lecture and you like this course so far, bookmark it, drop your questions, and also leave a review on this course, so that it's very much appreciated from you guys. So I'll be seeing you guys in the next lecture. Take care everybody. Bye bye. Hello guys, I'm particularly excited for this particular one because I'll be teaching you guys how to actually exit from trades. Now the best thing about trading is not about when you can actually enter, and any fool can click the buy or sell buttons and actually enter a trade. But the main thing is, when can you exit? Like, when do you know when to exit? Now there's the psychological aspect of that, and there's also the technical aspect of that, and in this lecture we'll be covering the technical aspect of that. So first of all, we are going to be looking at how to exit your trades according to structure, and I'll be showing you guys a few examples right here so you can get a clear grasp of what we are talking about here. Now we have this trade. Sorry about that. So we have this particular zone here. You can see we had one impulse move over here. It was a strong zone. Then we have this base. Then we had another move to the upside. Now what happened is that the market created this base, and you can see we have this order block right there. And now having this order block right here, this is on the 1 hour, like I told you. This is on the, then you go to the 5 minutes to take your entries. But the whole point of this is not about knowing where to take your entries. It's about knowing when to exit and where to exit. So the question is, where do you want to exit? Like, seriously, where do you want to exit? So if you're looking at this, you should actually be looking at it through structure. And first of all, if you understand structure, you should understand that the market moves in waves. Right here you can see we have, like in an uptrend, we have higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and all of that. So I'll just give you guys a short and simplest trick here. If you're actually buying, always look to exit at the next high, and if you're selling, look to exit at the next low. Now look at this, we are in a demand zone right here and we are looking to buy. Where are we going to be looking to exit? At the next high. And where is the next high? Right here. Now this tells you can see the market comes in and then sweeps this high, hits your take profit and all of that. Now what this does is actually keep you in check, because some of you guys are actually very greedy. You might want the market to just keep going up and up and up, and then the market comes all the way down, you become afraid, and then you close with no profit. So by actually knowing where to actually take your trades and your entries from, and where to exit, it tells you, it gives you a faint idea of how you can actually leave the market with your profit. Now we have another example here where we have the drop, the base, and the rally. Now having this, you can see clearly this is a demand zone. I think we've played with this pair before. Let's use this as a demand zone. Now you can see, as this is a demand zone, the market comes in here. The first place you should be looking to actually exit is at this point. If you're looking to buy this trade, the first place you look to exit is at this point. Now the market has not actually gotten there, but that's the best place to exit. Now you might actually choose to leave at this point, but this is close to the next high. So what is very important is that you leave at the next high, because if you're buying, because structure moves this way. When it goes up, it comes down, and then when you get to the next high, if you refuse to leave and take your money, what happens? The market comes down again. And then when it goes up to the next high, what happens? It comes down again. So for you to save yourself the emotional trauma of going through this whole cycle of up and down, and you get to the next high, leave. And most especially you're a scalper. So if you're scalping the Forex market, if you're scalping the market in general, you should not be looking to get. Sometimes you might leave before you get to the high because you've acquired a profit target. At least you get a 1 to 2 or 1 to 3, you should leave the market. You should just leave the market, you can see. So the whole idea is, if you're looking to buy, when you get to the next high, you should just leave the market immediately. Now if you're looking at it from the sell side perspective, let me show you guys something from a sell side perspective. Now you can see where we have a nice drop, and then we had a base, and then we had a massive liquidity pump right there. You can see this is not a low, this is not a weak low. The weak low is right here. This is another drop, the base, and the pump. You can see that this did not hold, because this was a weak low. You can see this did not hold. Obviously, like I taught you in the previous lesson, this was a liquidity trap. It didn't hold. But this first one, you can see how the candle closed. It closed very well. It actually held. This is the supply zone. And like I said, if you want to exit at the next low. Obviously, you can see when it got to the next low, it swept the next low. Although this was a weak low, like I told you, weak lows always get swept. It swept the next low, and then started reversing and going up. Now you don't want to go through the whole psychological roller coaster, so you should just leave. That's what happens. Like, it's the downside when structure happens. Let me clear this. Sorry about that. When structure happens to the downside, when you have this, you have a zone, you take your trade from here, look to target the next low. When you clear the next low, exit the market, because if you don't, the market is going to come down, so go up again and takes most of your profits before going down again. Now this is how the market moves. Like, you understand, the market moves in waves. So if you're actually looking to trade, you should be leaving look at the next lows, the lows and the lows. That should be your target. Now that is how you actually exit the market through structure. This is called structural exit. This is how you exit the market through structure. In the next lecture, we'll be looking at how to exit the market through exhaustion. So I hope you guys enjoyed this lecture. I'll be seeing you guys in the next one. Take care, everybody. Bye. Hey guys, in this lecture we'll be talking about how you can actually exit your trades using exhaustion points. Now in the previous lecture we talked about exiting your trades using structural points. Now exhaustion points are just simply weak highs and weak lows, liquidity traps. Now this is a way you can actually use liquidity. In the other lectures I taught you guys how to use liquidity pumps in your favor. Now this is how you use liquidity traps in your favor. And the thing is, you use liquidity traps in your favor because you're expecting the market to sweep out liquidity, so you can use it as a point of target, like a profit target area and all of that, to exit your trades. And now let me give you guys some examples. Now, first of all, you can see we have this nice demand zone right here. You can see we have a very clean rally, the base, and the next rally. Now you can see this rally actually ended with some sort of weak highs, but the lows were actually perfect. Now, these highs were, although the overall highs were not weak highs, but you can see the overall highs were not weak highs. So this is not more like a structural and exhaustion point. Now this right here is a weak high, and what this tells you is that the buyers were actually exhausted at this point, and then the sellers took over. That's why it's called exhaustion points. These are weak highs. So now you want to use this as a profit target. These are weak highs because that's why, you know, we call it exhaustion, because the buyers got exhausted at this point. Okay, I think I've said that before. Don't want to overemphasize. Now, so we have this demand zone right here. Let me, yeah, mark out this order block. Make it blue, mark out this order block. I draw it all the way here. Alright, so you see where the market came in right here. Your first target, like I say, your overall target should be the weak highs. And you can see right here, this is where you exit. Now, you see we have other weak highs right here. So all of this can be exit points for you. You can see when the market was going up. So if you would have gone all the way up. Now, these are areas of exhaustion. Like I said, the buyer, you see, the market got here, the buyers exhausted, went down, sellers took over for a while, came back here exhausted. And the sellers took over for a while until it came into the demand zone. And what happened was that this was, you can see this also are exhaustion points. Now you can use exhaustion points for entries, and these are actually nice levels for entries, but we're not talking about entries here. We're talking about exit. Now you can see, so if the market is going to be going up from here, you go down to the 5 minutes, as I taught you guys, get confirmation. Your overall target should be here, right here, this place. So your first target, although you can have multiple profit targets, that's the best thing about trading the Forex market. First of all, you have this target, which is your weak high. Then you have this target, which is another weak high. And then what does the market do? The market clears both highs. You see when the market came here, it cleared both highs. Now you can also look at this as a profit target, because first of all, you started taking this trade from here. You took this trade from here, your stop loss way below, and then your first profit target is here. It's here, but the market gets here and then reverses. And then you get another entry somewhere around there when you're on the 5 minutes taking your confirmation. Now, in the next lectures, we'll actually be looking at jumping into trades the second time. Now, you can see when you take the trade the second time, you set your target there, the market actually sweeps this weak high, sweeps this weak high, sweeps this weak high, totally. So you can actually use weak highs and exhaustion points as a point of entry. You can see how the market totally sweeps areas like that. And that's how you can use them as a point of exit on your trades. How easy that is. Most of these concepts are generally just easy concepts. You don't need to be complicated. No need for all the fancy terms and terminologies. So I want to give you guys one more examples, and I want to pick a random pair. So I'm thinking of the first pair that comes to my mind, and the first pair that comes to my mind is GBP NZD. So GBP NZD on the 1 hour. Now just note, you might have been noticing I haven't gone down to the 5 minutes. I'm just trying to give you guys overall view, and in the next sections of the lectures you're going to be seeing a full breakdown, total full breakdown of how I navigate a chart from the 1 hour all the way down to the 5 minutes. Now let's see. Now this is a very nice demand zone, but the market hasn't come back here yet, so we can't use this as an example. This is the current market. I want to look for something that has actually happened so that we can use it, and we can use it as structural exit point. I'll look for something that has happened. Okay, so oh no, I want to get something very I don't think this pair is a very good pair for me to actually give an example with. Let's pick another random pair. Let's go GBP CAD. Right, okay, all right, so GBP CAD, I think I've gotten something here. Now you can see we have this base, and then we have this drop, and then overall we have this supply zone. We have this supply zone over here, beautiful supply zone. And then where are we going to be targeting? First of all, you can see the market has these weak lows over here. See, these lows are ended in a week, and then you can see how weak those lows are. These are exhaustion points. This shows that the sellers got here, they got exhausted, and then the buyers took over. You can see the momentum of the buyers. Sellers got here, selling price, and the momentum of sellers actually died out. You can see the momentum of sellers actually died out, and then the buyers took over right here. So this is an exhaustion point. This is a weak low. This is an exhaustion point, and then when you take a trade from here, you expect to make this your exit point, because you know the market is definitely going to sweep this area clean. And that's how you actually trade using weak highs and weak lows, because one thing you know is that the market is always going to sweep those lows, all those areas. The market is always going to sweep those areas clean. That's how you actually trade with weak highs and weak lows. So guys, I hope you actually got value from this lecture. I hope you learned something from this. Now we're going to be going into the real good stuff in the next sections, because I'm going to be putting it all together to show you guys how I mark up the chart for analysis, giving you guys an overview of some pre-market analysis and also live trading, so you can implement this step by step in your own trading. I'll see you guys in the next lecture. Take care, everybody. Bye bye. Guys, welcome to this section of the course. In this section, I'll be showing you guys finally the good stuff, how you can actually approach the market, how you can analyze charts, how to start from the top to the bottom all the way down to entry and exit, everything. So sit tight and watch this video all the way to the end, because it's going to be revealing to you all the secrets of scalping in general, how you can spot zones, and how I navigate the market personally on a day-to-day basis. So like I said, when you come into the market, the first things you want to be looking for. Now this is a live market. The market hasn't opened yet. Market is basically open, but a lot of gaps and all of that. So the first thing we go down to is the 1 hour. You like to look at the charts from the 1 hour, because you're a scalper. Now you might say the market is bearish, but all of this doesn't concern you. Why do I say all of this doesn't concern you? You're a scalper. The long, you're not looking for all of this. You're not looking at all of it. You're looking at what's happening right now. What you want to see is what is happening right now. So you want to trade off what is happening right now, not what is happening or what's going to happen in the long run. No, you're a scalper. You just want to get in and get out immediately. Now, first of all, we have this zone. You can see this is what I'm looking at. This is what I'm seeing. I'm seeing a drop, seeing a base, and I'm seeing a rally. This is what I'm seeing on this particular chart, and this is the 1 hour. And first of all, this is my order block, so I'm waiting for the market to come in to my demand zone. But for some reason, the market hasn't come in my demand zone. Market has actually been going all the way up. But if we look over here, you can see we have another demand zone. You can see we have another drop, we have a base, now we have a rally, and now this area is actually showing exhaustion of buyers. You see the buyers, the move going up has become little and little and little and little and little. The move going up has become little and little and little. So what I'm expecting is the market to come back to this order block. Market to come back to this order block, and when it comes down to this order block, I'll be on the 5 minutes waiting for my pivot level, which I can see over here, and then I'm going to be looking to buy it all the way to clear this weak high right here. So typically this is how you do your analysis. First of all, you get this, you get the market all the way from the 1 hour, spot your supply and demand zones, and then if the market hasn't been in your zone yet, you have to just wait for it. You can't force it to come to your zone. But if the market is in your zone, that's when you go down to the 5 minutes. Now let's check another pair. I like the card JPY, or no, let's go with the card CHF. Let's see what we can get from the card CHF. Alright, so this is the 1 hour, obviously, in the card CHF. The first things first I would like to do is spot my demand zones, but obviously I don't think we have demand zones right here, right now. Although I can give you guys an example of how you can actually trade getting from entry exit. Over here we have a nice order block, because we had one rally, a base, and another rally. Sorry. Then now we have a demand zone, and then you go down to the 5 minutes to look for your, is that a 5? Alright, to look for your pivot level. Now this is how you approach the market on a day-to-day basis. All you need to do is to get your demand or supply zone depending on the structure of the market. Now we really don't have a pivot level right here. Can't find. Okay, we do have a pivot level. Let me draw a line. So we do have a pivot level right there. So let's make it a line. Alright, you can see where the market reacted the first time, reacted the second time, and then let's go all the way here. You can see the market reacted the third time, and when the market came in to our pivot level, didn't really break our pivot level all the way up. And first of all, we have another pivot level right here. Now this pair is weird. Can't find. We have another pivot level right here. Let me draw this. Yeah, you can see where the market reacted multiple times. First time, second time, the third time. Now I don't want to draw a zone because I don't want to make it confusing. But instead I'll just leave it as lines. So you can see where the market reacted the first time, the second time, and the third time. And we're coming to the future, you can see where the market broke with so much volume. Not all that much volume, so the market had to come back to retest on the zone to test it again. And you can see when the market tested the zone, it didn't hold all too well, and it came down again. And then after coming down, the market came up again, broke through the zone, and finally we saw momentum to the upside. So but I'm trying to make the market as live as possible for you guys, so I want to show you guys how it is to actually approach the market from a neutral position when it hasn't happened yet. So let's go AUD USD. I think should have a fresh market waiting for us. Okay, we've used this zone. Let's go to AUD. Let's find something. Oh, okay, let's go to NZD JPY. Alright, so NZD JPY is showing us something right here. Now imagine you're approaching the market for the very first time right here, which we are. We're on the 1 hour already, and then we can see we have this zone, which is a very nice zone, and it goes all the way up. Now if we mark this up, you should know two things. This is a demand zone. Secondly, this is a weak high. You can see this is a weak high. So if you're buying this, you should be expecting the market to clear this high. So immediately we're going down to the 5 minutes to look for our entries, and the market has been crazy. Now we have our pivot levels, way deep inside here. Now you can see where the market reacted off this pivot level right here. The first time, second time, third time, and then when it finally broke through this massive momentum, it came back to test this level. And then as a scalp trader, you would have entered your stop loss at the bottom, and if you target a 1 to 2, although we have a budget for a 1 to 2, but the market has come back in here to test. Let me make this pivot level. So maybe we'll take this trade, maybe I won't. Maybe I will take this trade because you can see the market broke the pivot level, came out to test it, broke it again, and came out to test it a second time. So you might take it, and then you look for it to clear this highs overall, so you can see what the market is going to do here. So guys, that's how I navigate the market on a day-to-day basis. I hope you got value from this, and I hope you learned something. And also try to leave a review on the course so far and on your questions, so I can answer and attend to all of them. I'll see you guys in the next course. Take care, everybody. Bye bye. Hey guys, welcome, and we're going to be doing some pre-market analysis. First of all, I want to show you guys how to actually do pre-market analysis, and I'm going to be doing it on the 3 asset classes we have, which is actually Forex, commodities, and indices. Now in Forex, we're going to be looking at Euro USD, which is on the chart right now, and in the next lectures you're going to be seeing the commodities and the indices I'm actually looking at in the next lecture. So first of all, we have Euro USD here, and before we actually approach the market and I'll show you how to do pre-market analysis, first things first, let me break down a trade, a very quick one, a trade I took a day before. I'll show you a trade I took a day before, which was right here. It was a very nice trade. It went to 1 to 4 risk to reward ratio, and then it was a very nice trade. So first of all, we'll go down to the 1 hour, and now this comes with experience because the demand zone I actually took was not, I took a demand zone right here. Demand zone I took this, I took this order block. Now you can see this was not a rally type of demand zone, but it comes with experience. When you actually have more experience in the market, you find out that when the market reacts, you react to the market. You don't try to predict what the market will do, you just react to what the market is telling you. So overall, I saw this demand and I went down to the 5 minutes. You guys know how I do it. It's just short and simple. And then over here I had this, yeah, we had this practically nice zone right here. Now if you go back to the 1 hour, let me go back to the 1 hour. There's something you'll see right here. Going back to the 1 hour, you can see we had a weak high right here, and that was my mission. I actually swept this trade through. It's not a very nice trade because immediately the market broke through this momentum and it came back to react a little bit. I jumped in, my stop loss was below, gave me like a 1 to 4. Yeah, you can see swept through the weak high, and this was a nice trade I actually took. And then this brings us to the next trade. Let's go to the next trade. Let me clear all of this off the chart. Let's go to the main reason why I'm making this video. Now this is Euro USD pre-market analysis. You can see over here we have the big rally. Now after this happened, we had a rally and then we had a base. You can see over here was the base and then we had a rally. Now you can see the market swept this high and then we had this. So overall this was the order block. We have the order block right here on the 1 hour. So currently this is the market right now. The market is moving away, but let me show you guys how I'm doing my pre-market analysis. So I'm on a 5 minutes and I'm looking at what am I going to be doing to the market as it's going away. First of all, we have one pivot level. Now you should understand you don't need to actually focus on one pivot level, because if you focus too much on this area, the market already has gone. So you need to be focusing on areas where you can actually make money from. So you can see the market clipped here, it has gone. The next area is here, right here. You can see this is a very nice pivot level. Now why is this a nice pivot level? You can see the market has reacted off this place once, twice, 3 times, 4 times, and then finally broke through all the way. So this is where I'll be looking to enter this trade. I think I might enter it now, but it's a few minutes before London session. So if I want to enter this trade, you can see over here we have some weak highs. Right here we have some weak highs, so I can just choose to enter this trade right now. I enter this trade right now. My stop loss right here for about 6 pips, and then my take profit for 1 to 3 or 1 to 4. I can get a 1 to 4 for sweeping that high. So this is this for Euro USD. I might take this trade, and if I take this trade, you're gonna be seeing it in the next lecture under the live trading section, me trading Euro USD. So I'll be seeing you guys in the next one. Take care everybody. Bye bye. Hey guys, like I said, we're gonna be doing a pre-market analysis across the 3 main asset classes. So in this asset class, we'll be looking at gold. We're actually looking at gold in this particular asset class. So let's go to gold, XAUUSD, pick this. And okay, now we're looking at gold. The first things first, like I said, go to the 1 hour. That's the most important. Now we're looking at the gold live markets. What are we looking at the market? What are we expecting the market to do? First of all, you can see we have this strong pump. You can identify things. We have the strong pump. We have this weak high, first of all. Then we have the strong pump. This is more like a drop, base, and a rally. So this is the liquidity pump. So this order block is very, very important. This order block is very important. So the market hasn't tapped into the order block and it's moving up yet. Now, instead of us leaving the market as it is, we have to look for other order blocks. Now, first of all, we can either wait for the market to come back here, or we can choose to find an order block where we can actually trade off of. So you can actually look at the market from an objective standpoint. Don't just wait for the market to come back to one point only. Just if you look over here, this is a drop. This is a drop, and this is a base. Now, what I'm expecting, sorry about that. What I'm expecting the market to do is to rally, so it can give us an order block. But since I'm seeing big bullish candles here, you can actually mark this as a potential order block. Now, I'm not sure yet. I'm expecting the market to rally a little bit and then come down, so we can go down to the 5 minutes and then clear this highs. So that's my overview for commodities such as gold. We'll be looking at something else, just a special trade from me. Looking at silver. Look at the silver, and just the same thing goes on. Now, what are the 1 hour? Okay, this is the 1 hour already. And if we look at silver, you can see we have this nice demand here. but the market hasn't come through. Now gold and silver are precious metals, so you should know they can actually move alike, but not necessarily all alike. Now the market is doing this. The market is expected to come out to this demand zone. Now what I'm seeing here is exhaustion. What did I tell you is exhaustion? The buyers are actually getting exhausted right here. You can see the buyers are getting exhausted. If you might have done your chart patterns, you should know that this is some sort of descending chart pattern and all of that. So what I'm expecting here to happen is a drop, a base, and a drop into this demand zone, so we can actually look for a pivot level and then buy, because there is a weak high over here, so that we can buy and also clear this high. The same thing that happens. But if this happens this way, if the market gives us a drop, if you don't know, this is why I said it's better to react off what the market is telling you. Don't try to predict. So we have to look at it from every possible angles. So if the market breaks through this zone, instead, this makes this a supply zone. So this makes it a drop, base, drop. We're going to be looking for an order block right here, so that we can actually sell from. But overall, we don't know what the market is going to do yet. We don't know what the market is going to do yet. So we just sit and wait. Here, actually, so anything that happens here, the market area has to rally all the way up or drop into the zone. So this is the two possibilities I'm actually looking at for gold and silver. And this is how you should actually approach the market objectively. Don't try to predict, just react. So in the next lecture, we're going to be talking about the last asset class, which is indices, and how you can actually approach it, because you actually have to approach that one a little bit differently. So with that being said, I'll see you guys in the next one. Take care, everybody. Bye-bye. Hey guys, and welcome to the final part of this section. In this lecture, we'll be looking at how you can actually do the pre-market analysis of the final asset class, which is indices. Now, like I told you, this requires precision, because indices are usually traded between the New York Stock Exchange Open, and they're very, very volatile. And the indices we're going to be choosing today is the US 30. And you can go and type it in, the US 30. Now, fun fact, I want to give you this. The US 30 is actually made up of the top 30 companies in the United States. Now, you can call it the Dow Jones, the Dow. It depends on you. You can call it the US Cash 30, but it's the US 30. Now, first of all, like we always do, we go down to the 1 hour. Now, the US 30 has been extremely bullish, and we have not had a zone. But like I said, it is a pre-market analysis. We're waiting for the market to actually react to our analysis. So first of all, we have this. Nice. This was nice. This was very good. And then this is one zone we're waiting for. And then we have this also. You can see this rally base. So we have this base over here, the order block. So in essence, in reality what we are waiting for is for the market to come down. Now what happens is that the market usually plays out during New York session. So we're expecting the market to come here and then buy, because the market is overall bullish, or it's gonna come here, pass through this one, and then buy. Now both of them are high probability zones, both of them are liquidity pump zones, but where we get confirmation is actually where we're gonna trade off of. Just so that's what we're gonna be doing. Now, just to make this worthwhile, I'm giving you guys another one, which is the XPX 500, the S&P 500, Standard & Poor's 500. You guys should know this. If you're from the United States, you know this is what you have been asked to invest in at the end of your retirement. So let's go down to the 1 hour. This is S&P. Okay, this is the 1 hour. I can't really put out price action for this because it's been choppy. Let's look for another broker, the XPX. Okay, right. So the expense. Okay, beautiful. So this is the 1 hour. It's more or less like the Nasdaq. We don't have anything yet. We're just waiting. Also, we have this. This is a nice base, but I highly doubt it's gonna hold. But who knows? I only react off what the market is telling me. So let's see what's gonna happen. One of two things is gonna happen to the XPX. But I'm fully focused on the US 30. The US 30 is actually my main focus. I like trading the US 30, so that's my main focus. So just in case some of you don't trade indices, it's perfectly fine, but I just want to show you guys what it's like to trade on a different asset class. And this is different because you can see this is much more different than Forex. Over here you can see, you think the stop loss over here is much because this is a 700 pip stop loss, and if you're hitting a take profit, this is like this is a 3000 pip take profit. So yeah, except you have to be very careful when you're trading. But this is all about doing pre-market analysis on the chart. This is how I come to the market. This is how I navigate the markets on a day-to-day basis as a scalp trader. And in the next sessions, you're going to be seeing some live trading I've done myself, and obviously for you to watch and enjoy. So I'll be seeing you guys there. Thank you, everybody. Bye-bye. So guys, it's the beginning of the London session, and I decided to take the trade which I actually previously break down for you guys. And I got in a little late, but let's just see where the market takes us. I currently want to make another entry right there. I want to make an entry right here. I make another entry. I don't know, with a 5 lot. So over here, let's see how the market actually plays out. And like, if you haven't know why I am taking this trade, you should go back to the charts, and you should actually go back to the previous lecture, and you'll see why I'm actually taking this trade. It's the beginning of London session, that's why I just actually took this trade now. So let's sit back, watch this trade, and see why I'm actually taking this trade. So I'm currently in drawdown, but I'm waiting for the market to actually play out so that I can actually get in, so I can actually live. So I think the volatility hasn't kicked in yet, but let's sit back and watch the market play out. See, this is a strong pivot level for us, so we should be expecting the market to buy from here all the way up. Also, my target is at this week high. Like I told you guys, my target is at this week high. So waiting for the market to play out. Let's see what's gonna happen. quick update on the trade. Euro USD, currently we are approaching the highs. Volatility isn't that much, but currently we are approaching 2R. Now am I close at 2R? Like I told you guys, I like to get my things at 2R. Am I close at 2R? But I wanted you guys to see what it's like for the market to sweep this high, so I might leave it running for complete 4R, 4%. And currently you can see we're running close to above $300 on this. Yeah, the market is slow, choppy movements and all of that, but it depends. I might decide to close this. If I decide to close this here, I'll let you guys know. Otherwise I'll just, if I decide to close it here, I'll let you guys know, but otherwise I'll just let it ride for you guys to see how this actually plays out and how it's going to sweep this weak highs over here, because I know it's going to sweep it. So it's just for you guys to see it right here. So you guys might not see it sweep it, but I'm just going to send it out. If it finally does, I'm going to send it out. You guys are going to see it. You guys are going to see me close the trade. But for now, we are already at 2R, but let's see how it goes. Hey guys, quick update on the Euro USD trade, and you can see over here we are past 2R. We are about 2.2%, 2.3. So what I'm going to be doing here is I'll be closing partials, because it's very important, also because I have other things to go do. So I'll be closing partials. We're already at $400, so obviously I'm looking to make 1,000 from this trade, so, or maybe 2,000, it depends. So I'm going to be closing half right here. So I'm going to be closing 2, close. All right, so the rest of the trade right here, I'm going to be setting my stop loss to break even, so I can actually run risk free, and then I'll set my take profit at this point. I'll just leave it open so you guys can see when I close it. So I'll set my stop loss to break even. All right, break even, that's good. So the other stop loss is on 1.07718. I'll set that at break even. Hey, that is too close. I'll bring that down a little bit. All right, so currently I'm at break even. I'll update you guys when this actually sweeps this high. And that's it, guys. That's it. I'll be waiting for the market to actually hit my take profit level. I don't want to set a take profit level, but I just wanted to get to this high so you can see when it sweeps, and then we'll talk. All right, I'll see you guys when I update you guys in the next one. Cheers. Hey guys, so as you can see, the weak highs here has already been swept. You can see the weak highs here were already swept. It was swept clean with a big candle. And overall, I closed this trade for 1 to 4. And like I told you, the weak highs always get swept. So this is just the power of you knowing how to scalp efficiently. This is the power of you knowing how to actually trade the market, and navigate the market on a scalp level, on a scalping basis. So if you actually enjoyed this live trading session as much as I enjoyed making it, although it's a little bit long, but I actually did my best to make it shorter, so that's why I had to divide it into 2 lectures, because the main it took about 30 minutes 35 minutes to actually get to this take profit level, so I had to put it down 2 lectures. So I hope you enjoyed it. You can see how all the concepts I taught you in the previous lectures actually played out, and how I actually cut this trade from start to finish. So I'll be seeing you guys in the next lecture. Take care, everybody. Bye-bye. Hey guys, I am the Trading Pirate, the founder of the Pirate Academy, and I want to just say a very big thank you to you guys who have actually purchased and gone through this course. I hope it actually met your expectations, and I hope it was fun for you, and at the same time educative to and helpful to you as it was to me when I was making this. Just remember, being a scalp trader, you need to actually be able to think fast and execute fast, and with the methods and the step-by-step strategies I've taught you guys here, it should be a no-brainer for you to actually go into the scalp trading world and dominate. So with that being said, I want to ask you guys for something, a little favor, just a little. I want you guys to go drop a review on the course, also your questions, because I like when the students of a particular course drops their questions for me to answer. It shows the students are actually following with the course. So I want you to drop your questions and all of that. I will be answering every single one of them, and also drop your reviews. Don't be afraid to drop a 1, 2, 3, 4, 5-star review, because every single review is highly appreciated. So with that, I want to say I wish you success in your trading journey, and I hope this was actually insightful, and this is what is going to kickstart your trading journey into the world of scalp trading. Take care, everybody.